Hello everyone, Dave Landry here from DaveLandry.com. This is Trading Simplified. So what we can talk about? Well, I have a lot to say about the methodology and action. We'll talk a little bit about a recent sell signal that we received, a couple of longs that we're hanging on to, not because we're being obstinate, but because that's what the methodology calls for. And then I'm going to pick up my series on Jesse Livermore. By the way, I do take requests. You could send them to DaveLandry.com/contact, fill out a form there, and I'll be happy to cover what you want. You could also attend a live webinar each week, or usually each week, at DaveLandry.com/webinar. Go there to register. Here's all the other information, lots of places to reach me and find me. I do have a traders group, or a trading room if you want to call it that, and that's Dave Landry's Trend Traders, and that's on Facebook, but you must at least be a gold member to participate. The group is free, but you have to be qualified by being a gold member. All right, let's hop into the mystery charts and the methodology in action. So LFMD triggered a while back. It was a nice Landry light pullback. And basically, we're just looking for about 20 days or so. In this case, we had about 40 days of upside Landry light. That means the lows are greater than the 30 EMA. And this is the EMA we're using here. You could use different EMAs if you want, or even simple moving averages as I use in the TFM 10% system, which I'll show you here in just 1 second. Now, in addition to those 20 days of Landry light, you need to pull back to the 30 EMA. That's the rules on a technical basis. However, when you go to trade this, make sure you look at the actual chart. Notice the stock accelerated higher. It had a bit of a slow start, kind of consolidated in here, and then it really took off. Also notice that it's persistent, and then had a nice clean pullback to the moving average. And in general, it tends to trade cleanly. So this is pretty much a textbook setup. In fact, you should trade all your setups in a textbook manner. I've been accused of cherry picking before, but the reality is I cherry pick every single setup going into the trade. So it's not like I'm going backwards in time and finding the best setup to show you. These are stocks that I showed you when I first saw them, if you go back and look at the mystery charts. Anyway, nice little pullback to the 30 EMA. So remember, this just counts the number of lows greater than the 30 EMA, and it goes back to 0 as soon as the price touches the moving average. I used to call this kiss ma goodbye, ma being moving average, and now I'll call it Landry light pullbacks. Anyway, this was a trading service for this particular day. This was on the 20th or thereabouts. This date here just tells you when I first recommend the stock. So I recommended it first on the 20th. And here are your parameters down here. Fairly loose parameters, but if you look at the actual stock, it's fairly close to where the stock's trading. Entry was there, the stop down here around 3, and IPT up here. IPT, initial profit target. And that's where we're going to take off half of our shares. By the way, one reason I want to show you this trade is because it's turned into a longer-term trend-following trade in spite of what appeared to be the beginnings of a bear market. So the market top was on 727. Of course, that's in perfect hindsight. We didn't know it at the time, but you could see for a few weeks the stock really didn't do a whole lot. And during that time frame, looking at the overall market, you might have thought about quitting. And I noticed that some people were getting a little tired of sitting in this stock and thinking about quitting, especially with the market behaving as it has been. And my mantra is to just follow your methodology. And if your methodology calls you to exit if your stop is hit, then you exit if your stop is hit. If there's nothing to do, then do nothing. A lot of people might call that dead money. Dead money has little or no chance of ever making you any money, but you don't know that. So I often do what I call a dead money report, where I show stocks that go sideways for a little while, but they never stop us out and then subsequently take off, just like this one did, obviously. So once we get the initial profit target out of the position, we move our stop to break even. Now we will trail it higher a little bit before that IPT is hit. Some of my clients don't, but I recommend you do trail it as it moves in your favor on sort of a one-to-one basis. So if the stock goes up 1 point, you raise your stop 1 point. Now, in more recent years, I've been a little bit more lenient on that first loaf, so to speak. But in general, you want to shoot for 1-to-1. And once the initial profit target is hit and your stop's at break even, you're sort of playing with the market's money, so to speak, as Charlie Kirk called it when I showed him my money management. He called it free rolling. By the way, Charlie's not doing too good. He had a really bad accident, and I'll give a link to the GoFundMe page on that. But he's doing better, but he's going to be a paraplegic, looks like, and it's just not a good situation, unfortunately. Sorry to be a Debbie Downer for those of you who know Charlie, but if you can help him out, that would be fantastic. But anyway, before I digress too far, the initial profit target was hit, stop goes to break even, and then I begin trailing the stop a little bit more loosely on the remainder. Now, I just grabbed the price snapshot a few minutes ago, and it was at 754. Remember, our entry was 425. So that's a 77% gain in spite of what appeared to be at least a bear market and some really nasty sell-offs in the overall market. KNF, another stock that triggered before all this mess began in the overall market. This is a first pullback in an IPO, and then once there was enough days for the moving average, a 30 EMA, you can see it's also a Landry light pullback. So there are the parameters there. It was on the same day as I recommended the LFMD, but you can see in this case it took a while for it to trigger. I first recommended it on 7/6, and then it triggered much later than that. So the entry was here, stop was down here, initial profit target up here. Now again, the market topped, ironically, on the day that this one triggered. And of course, you don't know the market at the top, but even if you did, if you had exited this stock, you would have lost money instead of making a decent amount of money. So far, knock on wood, obviously. So again, once that initial profit target is hit, you want to bring that stop up to break even. And then, again, you're free rolling, as Charlie would say. And then we slowly loosen that stop up over time in an attempt to ride out a longer-term trend. Yesterday, there was earnings. It really took off. Unfortunately, it's coming back in a little bit today, but maybe it'll consolidate and take off again. And so far, it's really holding up nicely above this big old base in here. So that's a good thing, obviously, so far. Once again, you could argue about dead money. I don't believe in time stops, at least not for something like longer-term trend following or the swing to intermediate-term approach that I like to follow with the overall market. Remember, we get in for what hopefully is a swing trade, something that doesn't take quite as long to hit that IPT, and then trail a stop in an ideal world. Obviously, you want to hit the IPT as quickly as possible. But it did hit it fairly quickly. It hit it within a week or so, which is a decent thing. But again, once again, dead money, but then it did take off again. So just follow your system is the point with this. And I did a update last week on what happened since the bear market began, and looks like we might be at least coming out of it temporarily for now, and I'll show you that in just one second. And the point is, it won't always work this well, but the point I was making, and I'm making it again today, is that you want to just follow your system, good, bad, or indifferent. All right, let's talk about a stock that's not a mystery chart. I just triggered a little while ago. This is CEIX. It's what I call a first thrust. It's also a reversal gap strategy. A first thrust is when a stock makes all-time highs. Everybody is happy because they're making money. It then has a sharp sell-off. In this case, we've got a gap 2, which suggests extreme weakness, and also that sets up the reversal gap strategy after it pulls back. But the thing is, anyone who bought the stock above, let's say, 100, once it drops below 100, obviously, is losing money. And when this stock begins to rally a little bit, there's going to be a lot of sellers potentially around 100 or above. So here's the parameters. You can see entry 92, stop 105, IPT of 79. Entry was here. It triggered a little earlier this morning. It's since bounced, but looks like it's weakening once again. So we might be okay. Again, let's not focus too much on the day-to-day action and just follow the methodology. Stop is up there at 105 again, and IPT is down here. So I'll follow up on that one in upcoming weeks, and we'll see what happens. Now, we did have a recent TFM 10% system sell, and I'll show you that right now. So the TFM 10% system uses a 50-week moving average. By the way, the indicators that I'm using in here were created with ACP, and they are free as part of my plugin. If you like this video, you'll have free access to the plugin. Just hit the little plugin right here after, of course, you like the video. Now, the TFM 10% system is based on a 50-week closing high. As long as the market is within 5% of the 50-week closing high, and you can see the parameters are right here. So 95% would be this line here. 100% would be the top of this line here, which is equivalent to the 50-week closing high. But as long as you're within 5% of that 50-week closing high, the market's in pretty good shape. When you drop 5% or more, as one of my clients was pointing out, that's really a caution zone, and he likes to get out a little bit more quickly. And I tend to agree with him there, but I kind of see it as a caution zone. I still follow the actual system. Now, once you're 10% or more away from that 50-week closing high, that's where bad things do tend to happen. So less than 5% is the green. More than 5% would be the pink. And then the red down here, or dark pink, is 10% or more. The 10% line would be right there. Now let's take a look at the system. So you want to sell when the weekly close is 10% or more away from the 50-week closing high, and the close is less than the 50-week SMA. Now you can see it triggered a sell signal and the market turned right back around. Now that happens, okay? It happens, spelled with a silent SH. As Greg Morris once said, whipsaws are frustrating, bear markets are devastating. You could survive frustration. Now, the buy signal would be the weekly close is less than 10% away from the 50-week closing high. So really, anything above this red line in here, okay? And you have 2 bars of upside Landry lights. So if we don't dip back below the 50-week simple moving average, remember this is a weekly sell signal. It's a little bit longer term, although it did trigger pretty quickly in the pandemic. But it was designed to be a longer term type of trend following system. So if we hold above the 50, the low holds above the 50 for this week, and then next week, then it would be actually a buy signal, and that would be considered a whipsaw. But hey, again, it happens. Now, just to show you a previous buy, you can see this low and this low were both greater than the 50-week moving average, and you close within 10% of the 50-week closing high. I am long just 100 shares, but I've been long the Qs for a long time in this, and I haven't received the sell signal just yet. So far, so good on that, knock on wood. So again, we have 1 bar of Landry light. If we make it to Friday, today is November 7th. So if we make it to Friday, that would be 1 week. And if the following Friday, the low is still greater than the moving average, then it would actually be a buy signal. All right, let's shift gears and jump back into the wisdom of Jesse Livermore for Mind the Trade. Now, again, as I say each week, most of what I'm covering comes straight from Reminiscence of a Stock Operator, and I am using the other 2 books, one by Richard Smitten, which is a biography on Livermore. Spoiler alert, it does end badly for Mr. Livermore. He put a bullet in his head, but that's another story. And then How to Trade Stocks. And I'm using these 2 for color commentary just to kind of get a little insight into Mr. Livermore. But mostly, again, everything comes from Reminiscence. And this week we're up to chapter 22, and we'll see how far we can get. So we last left off, there was a lot of talk about the fact that markets are manipulated. And I received a tweet or 2 about that saying, well, what good is that for the trader who can't rush out and manipulate markets? Well, the point I was making is markets are manipulated, but you want to seek to get on the right side of the manipulation. So if the market is being manipulated and it's going higher, then as a trend follower, you want to be a buyer of that market. Now, in chapter 22 of Reminiscence, there was a lot more talk about manipulation, which I know you can't do anything with that, but again, you can get on the right side of it. And there were a few gems within the chapter. So Livermore was hired to manipulate a stock higher so that the insiders could unload it. The stock went higher just based on rumors on its own. There were some rumors that Livermore was going to be behind the campaign to push the stock higher, and that got released through the newspapers, and then the stock was pushed higher. Now, some of the insiders were mad at him because Livermore had, I believe, $4 million to push the stock higher, and he didn't spend a cent. But the point is, there was no need to put capital into harm's way. Now, Livermore did talk a little bit about revenge as it relates to these people getting angry because he didn't spend any money to push the stock even higher. And that was based on their own internal greed. They succeeded in getting the price higher, but some of the people wanted to pile on the stock and make a big profit. Now, one thing he talked about with revenge is it never pays to be a dog in the manger in Wall Street or anywhere else. Now, I wasn't familiar with this term, so I had to do a little Googling and look at the footnotes, etc. But a dog in a manger is a person who has no need of or ability to use a possession that would be of use or value to others, but who prevents others from having it. And the saying comes from a fable about a dog that's sitting in a manger on some hay, and an ox would like to eat the hay. The dog can't eat the hay or doesn't want to eat the hay either, but he prevents the ox from eating the hay. So you have to be careful not to revenge trade, and you have to be careful not to get angry with the market, is his point in all this. Now, speaking of anger, getting angry doesn't get a man anywhere. More than once, it has been borne in on me that a speculator who loses his temper is a goner. And there's 50 ways to lose your money, as you probably know, in the markets. And it's really hard not to get angry, but you really have to manage it and let the chips fall where they may. Now, Livermore did get a little philosophical once we got into chapter 23. Speculation in stocks will never disappear. It isn't desirable that it should. It cannot be checked by warnings as to its dangers. You cannot prevent people from guessing wrong, no matter how able or how experienced they may be. Carefully laid plans will miscarry because the unexpected and even the unexpectable will happen. Disaster may come from a convulsion of nature, or from the weather, or from your own greed, or from some man's vanity, from fear, or from uncontrolled hope. But apart from what one might call his natural foes, a speculator in stocks has to contend with certain practices or abuses that are indefensible morally as well as commercially. So a lot of things can happen, and I think Mark Douglas said it the best when he said, all it takes is one a-hole to screw up a perfectly good trade. So that's why I just pick the best, of course, leave the rest. I know it's cliche, but that's why I cherry pick my stocks, as I've said earlier, and I just follow my methodology. And I make it sound a lot easier than it really is, and I realize that. And in my own trading outside of my core methodology, I do make some mistakes, and a lot of times I question whether or not I should be doing these type of things. But I know from 20-something years of the swing to intermediate term trading what has to be done and when it has to be done. And a lot of times there's nothing to be done, and you got to be careful not to get caught up, not to get angry, and not to let human nature rear its ugly head. So Livermore did get pretty philosophical as we're getting toward the end of this book. In addition to trying to determine how to make money, one must also try to keep from losing money. Amen. That could be through stops, and as I often preach, a good offense is your best defense. So I'm kind of sneaking this in a little bit this week, but cherry pick those stocks, pick the best, and leave the rest. And that's why sometimes, and I lose a lot of clients doing this, but I'm over it. I could deal with it. I will not recommend any stocks for weeks and sometimes a month or more if there's nothing that I personally want to do myself, feel like I should be doing myself. I'm not going to just produce product to keep people happy that are looking for action. As I've said 1,000 times, I was once part of this team with kind of a who's who of trading: Greg Morris, Larry McMillan, and then a whole bunch of other people. I hate to name them all because I'm probably leave somebody out. And it was a bit of a pinch me type of moment, but the ringleader was Peter Mothy, and he explained how the newsletter was going to work. It's a $40,000 a year newsletter, and he explained that we would get paid if we produce setups. If we didn't do anything, we didn't get paid anything. So there was a temptation, of course, to produce setups when there was nothing to do, but I wasn't going to allow myself to do that in that particular project either. And so I called him up and I said, I don't know if I'm the right guy for this project because I might go weeks and sometimes longer without anything to do. And in those situations, obviously I won't get paid and you won't have product. And he said, Dave, you are the exact guy we are looking for. You're exactly the kind of guy we're looking for. Don't invent trades. And that really stuck with me. And so I would urge you to cherry pick and don't invent trades. It is almost as important to know what not to do as to know what should be done. Well, if you think about it, if you knew when not to trade, you'd own the world. That's almost a holy grail in and of itself, and never attainable. However, you can maybe improve upon that a little bit by picking better stocks, and when the market's chopping back and forth and behaving erratically, and you can't find a setup to save your life, maybe just sit on your hands. It is therefore well to remember that manipulation of some sort enters into practically all advances in individual stocks, and that such advances are engineered by insiders with one object in view, and only one, and that is to sell at the best profit possible. Well, everybody who buys a stock thinks it's going higher. Nobody would buy a stock in order to lose money. So see markets as being manipulated and just ride the manipulation, as I've been preaching. However, the average broker's customer believes himself to be a businessman from Missouri if he insists upon being told why a certain stock goes up. And in this chapter, he gets into a lot of how the newspapers are always bullish on stocks, and the newspapers create these narratives as to why the stock's going up. Naturally, the manipulators explain advance in a way calculated to facilitate distribution. I am firmly convinced that the public's losses would be greatly reduced if no anonymous statements of a bullish nature were allowed to be printed. I mean statements calculated to make the public buy or hold stocks. I don't watch the news, or I do get a little through osmosis here and there, but I try to avoid as much news as possible, and I certainly don't watch the financial news. When we asked a prominent director of the company to explain the weakness in the stock, he replied that the only conclusion he could arrive at was that the decay today was caused by a bear drive. Underlying conditions are unchanged. The business of the company was never better than at present, and the probabilities are that unless something entirely unforeseen happens in the meantime, there will be an increase in the rates at the next dividend meeting. The bear party in the market has become aggressive, and the weakness in the stock was clearly a raid intended to dislodge weakly held stock. I once met a CEO once, and he was all rosy about the company, and then I later found out that he was dumping shares on the market. So markets are manipulated. Everybody's trying to get their best price possible, and sometimes there's something wrong with a company. It just goes down. And by the way, if a stock is going down, there's something wrong. If you're not stopped out, then stay with it. But if you're stopped out, get out the way. He who fights and runs away lives to fight another day. I've done my share of trading and have kept fairly well posted on the stock market for many years, and I could say that I do not recall an instance where a bear raid caused the stock to decline extensively. What was called bear raiding was nothing but selling based on accurate knowledge of real conditions, but we're not due to say that the stock declined on inside selling or inside non-buying. Everybody would hasten to sell, and when everybody sells and nobody buys, there is the dickens to pay. When the stock keeps going down, you can bet that there's something wrong with it, either the market for it or the company. If the decline were unjustified, the stock would soon sell below its real value, and that would bring in buying that would check the decline. As a matter of fact, the only time a bear can make big money selling a stock is when the stock is too high. Now, you don't want to sell something just because it's high, but if the stock is overpriced and declining to reach a value, so to speak, then it is what it is, and the stock is headed lower. Well, that's all my time for this week. If, again, you want the slides, davelandry.com/stockcharts. You can reach me, davelandry.com/contact. Join me each week for my weekly live webinar at davelandry.com/webinar. I want to thank everybody for watching, and may the trend be with you.